If I had to start investing in defense stocks today from scratch, knowing what I know about where military budgets are moving, how modern warfare is changing, and what Wall Street usually misses before the big money crowds in, I would do this very differently. Most people think a defense trade starts the moment a conflict hits the headlines, but that is not really what this is about anymore. We are looking at a deeper shift in how governments want to fight, how they want to deter, and how they want to rebuild the industrial and digital backbone behind all of it. It is Saturday, April 18th in New York, so go ahead and tell me in the comments what day and date you are watching from. And if you value the way I break this stuff down, subscribe and comment John A.G. Best, so I know you want more of it. Now, the part a lot of people are getting wrong is this. The story here is not just the latest conflict. That is the headline. That is the attention magnet. But the real defense story started earlier, and from recent budget reporting, it is very clear the people writing the checks are thinking much bigger. The administration has been defending a fiscal 2027 military budget plan that would push overall spending close to $1.5 trillion, a move tied to ships, planes, drones, and broader infrastructure build-out. That is not a little tweak around the edges. That is the kind of request that tells you the playbook is changing, and when the playbook changes, the winners are not always the names everybody already owns. That is why I am not here to just throw every defense ticker into one basket and call it a strategy. Some names are too crowded, some are too obvious. Some are going to get the headlines without ever getting the earnings power, but some are sitting in the right lanes before institutional ownership really deepens. And that is where things can get interesting, because future warfare is not one theme. It is not just drones. It is not just missile defense. It is not just software. It is not just ships. It is all of it working together. Hardware, autonomy, targeting, cyber protection, logistics, shipyard capacity, industrial throughput, and systems integration. That whole stack matters. And if the government is preparing to fund more of that stack at the same time, allies are raising their own commitments, you want to know which businesses are plugged into the right parts of the machine. That is the bigger frame. And the reason I think the opportunity is still there is simple. Even after the broader market snapped higher, a lot of these defense names did not move like fully loved, fully priced, fully owned winners. Some got a polite bounce. Some barely woke up. That tells me the market still is not completely settled on where the next leg of spending will land, or how quickly it will land, or which names are too early versus which names are early enough. There is also a healthy reason to be skeptical. A giant spending plan is not a signed blank check. Congress can reshape things. Programs can slip. Contracts can get delayed. Expectations can run hotter than reality. So no, this is not me telling you every defense stock is a golden ticket. I am talking about three names that each represent a different pillar of the modernization story. One gives you autonomous warfare and counter-drone exposure. One gives you the software, cyber, and mission systems layer that makes modern defense actually function. And one gives you the shipbuilding and maritime capacity angle that Washington suddenly cannot stop talking about. That combination matters, because if one lane pauses, another lane can still carry the thesis. So let us start with the one that has probably made the most people excited, terrified, and confused all in the same year. Kratos. Kratos, to me, is one of the clearest pure plays on the idea that warfare is moving toward lower-cost autonomous systems, tactical drones, and the ability to counter those systems at scale. This is not some vague concept stock with a cool deck and no traction. According to the company's latest annual filing and full-year results, Kratos closed last year with revenue around $1.3 billion, backlog above $1.5 billion, and strong growth across its unmanned systems, microwave products, and training and cyber lines. That matters because it tells you the story is not just futuristic. It is already commercializing. And the Valkyrie piece is a big reason investors keep coming back. The Marine Corps has already been involved with that platform. And from recent company disclosures, Kratos is still investing ahead of expected demand tied to unmanned jet aircraft, propulsion, and related production expansion. In plain English, they are not acting like this is a passing phase. They are acting like they believe procurement is broadening. Now here's where it gets interesting. The stock had a huge run over the last year, and then it got absolutely slapped. A lot of hot money came in. A lot of hot money came out. That kind of move tends to do two things. First, it scares people into thinking the story broke. Second, it forces the market to ask whether the pullback is a warning or a gift. I do not think the answer is automatic. Kratos is still speculative. Let us not pretend otherwise. When you are tied to future program scale, capacity build-out, and investor expectations that can outrun near-term earnings, you are going to get volatility. You are going to get people asking whether too much future success has already been priced in. You are going to get people saying, maybe the stock moved too far too fast. That can all be true, and the bigger theme can still remain intact. Because what the market often does with a stock like this is confuse timing with direction. Timing is messy. Funding windows move. Production ramps take time. Orders do not arrive on the exact day traders want them to arrive. But direction is something else. And the direction here still looks strong to me. If defense planners want more autonomous platforms, more affordable, attritable systems, more counter-drone capability, and faster deployment cycles, Kratos is sitting in the right neighborhood. That does not mean the road is smooth. It does mean the address is right. Now let us move to the second name, because this one tells a very different part of the same story. Leidos. If Kratos is the hardware and autonomy angle, Leidos is the systems brain, the software layer, the data layer, the cyber layer, the modernized mission layer. This is the kind of company that tends to matter more than it looks because so much of defense is no longer about a single platform. It is about whether everything talks to everything else securely and reliably. And from the latest publicly available filings, this is not some tiny side player. Leidos just reported full-year revenue of roughly $17 billion, annual earnings growth, and very strong cash generation, even while openly acknowledging that a 6-week government shutdown affected results. The company also said its national security and digital segment made up a very large chunk of total revenue, which tells you where a lot of the strategic value sits. That is the good side. The messy side is that the stock has had real pressure. It missed on revenue in the latest period. The shutdown did matter, and because it has software exposure, the market has also started throwing the usual lazy question at it. What if artificial intelligence just eats the whole category? I think that is too simplistic. Consumer software and mission-critical defense systems are not the same animal. In normal enterprise software, yes, AI can disrupt quickly. In defense, integration cycles are slower, approval layers are heavier, and replacement is harder. The Pentagon has already shown it is being careful about how contractors use AI models in sensitive work. That alone should tell you this is not a light switch transition where every incumbent gets pushed out overnight. Defense contracts are sticky for a reason. Once you are embedded in workflows, systems, security requirements, and operations, moving away is not easy. It is expensive. It is risky. It is slow. So while AI absolutely changes the long game, I do not think it automatically nukes the case for a company like Leidos. In fact, it may end up strengthening the moat for the firms that are already integrated into mission-critical environments. There is another angle here too. Leidos has fresh strategic movement happening right now. Just days ago, the company announced a transaction that combines parts of its security and industrial automation businesses into a new venture aimed at accelerating AI-native and advanced imaging security products. That is not a company standing still and hoping the fear goes away. That is a company trying to reposition parts of the portfolio while keeping a stake in the upside. And then you have the Homeland Defense angle. Leidos sits on the SHIELD contract vehicle tied to the broader Golden Dome architecture, which means it has a seat at the table if those layers of missile defense and command system spending accelerate. Again, that is not the same as saying the upside is guaranteed. It is not. But it means the optionality is real. So yes, I would call Leidos more complicated than Kratos. Maybe even more speculative in the short run, because there is more narrative friction here and more debate around what the market should pay for it. But the reason I still like it is that the market may be focusing too much on the temporary mess and not enough on the long-term glue. This company is glue. Systems integration, cyber resilience, mission analytics, modernization. That stuff does not look exciting until a government suddenly realizes it cannot function without it. And then we get to the third name, which might sound the least flashy at first, but may actually be one of the most strategically important: Huntington Ingalls. Now on the surface, this sounds old school. Ships, yards, heavy industry, long cycle contracts. Not exactly the kind of story that usually gets traders leaning forward. But here's the thing. Washington is no longer whispering about the maritime problem. It is saying it out loud. America needs more shipbuilding capacity, better throughput, stronger repair capability, and a more durable industrial base. That is now policy language, not just investor chatter. The White House Maritime Action Plan released earlier this year puts domestic shipbuilding expansion, shipyard investment, and maritime industrial resilience right at the center of national strategy. That matters because when policy finally admits a bottleneck is real, the companies that can help relieve that bottleneck get more valuable. And Huntington is sitting right in the middle of that conversation. From the company's latest annual report, Huntington generated about $12.5 billion in revenue last year, grew sales, improved earnings, increased shipbuilding throughput by roughly the mid-teens, and invested more than $400 million into capital improvements. That is not a sleepy operator. That is a company trying to raise capacity at the exact moment capacity is becoming strategic. And here is the part many people miss. Huntington is not just steel and shipyards anymore. Its mission technology segment crossed the $3 billion mark last year and gives the company exposure to unmanned systems, cyber work, advanced technical services, and the broader digital layer behind next-generation defense. So no, the majority of revenue still comes from shipbuilding. But the company is not trapped in the past. It is building a bridge between old-school industrial muscle and the newer technology stack. That bridge matters a lot, because the ships being planned for the next cycle are not just bigger versions of older vessels. They are more connected, more software-defined, more sensor-heavy, and more tied into broader command networks. That means a company combining shipbuilding scale with mission tech capability can benefit from both the rebuild and the modernization inside the rebuild. There is also a larger global reason I like this name. NATO allies and Canada just posted a very sharp increase in defense spending, and alliance leadership keeps pushing members toward an even higher commitment path. That does not directly write a check to Huntington tomorrow morning, but it reinforces the reality that maritime capacity, industrial resilience, and mission support are becoming larger shared priorities across the Western defense ecosystem. If you're successful, share your success story in the comments so others can stay motivated. So when I put these three together, I do not see random defense stocks. I see a pattern. Kratos is the autonomous edge, Leidos is the digital nervous system, Huntington is the maritime and industrial backbone. And the reason I think the window may be closing is not because these names cannot pull back again. They can. They probably will. The reason is that institutions tend to move hardest after the story becomes comfortable, after the earnings beats line up, after the contracts are obvious, after the policy path is easier to see. By then, a lot of the easy upside is already spoken for. That is why I like looking before the ownership fully broadens, not before the story exists, before the crowd gets comfortable with it. One more thing, and I think this is important. People hear under-owned and they instantly assume that means institutions are missing something obvious. Sometimes they are. Sometimes they are just slow because size, liquidity, and mandate rules make them slow. In broad defense and aerospace funds, you will often find pieces of these themes, but not always in the size you would expect if the market were already fully convinced. That matters, because when institutional accumulation finally gets serious, price action can stop looking sleepy in a hurry. The counterpoint, of course, is that some of these names may stay niche longer than bulls expect. Kratos has to keep proving scale. Leidos has to clear noise and show cleaner acceleration. Huntington has to turn national urgency into actual throughput and contract conversion. Those are not tiny hurdles. But I would rather study imperfect stories that are early than perfect stories everyone already agrees on. Usually, by the time the agreement is unanimous, the valuation has already done most of the talking for you. And that is the whole game here. Finding where policy, spending, and technology are beginning to line up before the market decides the conclusion was obvious all along. As always, this is here to educate and help you think, not to make decisions for you. Take what is useful, leave what is not, do your own homework, and never risk real money on a story you only understand when the chart is going up.